morning, everyone. Today, we will tackle about the Federal Reserve and European Central Bank. This topic covers the history, structure, and monetary policy strategies. So let's now first discuss the European Central Bank. So what is European Central Bank? The European Central Bank, or ECB, is the central bank of the Eurozone. Eurozone means a collective of European countries that use the euro as their sole official currency. The ECB is responsible for administering monetary policy and safeguarding the value of the euro. Given the relative size of the Eurozone economy, actions undertaken by ECB garner nearly as much attention from U.S. traders as the action of the Federal Reserve. The ECB is governed much like the Federal Reserve. Decisions are made by the Governing Council, which consists of 6 members of the Executive Board, plus the governors of the national central banks of the Euro area countries. The ECB, the Governing Council, makes monetary policy for the Eurozone, and the European Union administers the foreign exchange reserve for European Union member states, engage in foreign exchange operation, and defines the intermediate monetary objectives and key interest rate of the European Union. The ECB Executive Board enforces the policies and decisions of the Governing Council and may direct the national central banks when doing so. The ECB has the exclusive right to authorize the issuance of euro banknotes. Member states can issue euro coins, but the volume must be approved by the ECB beforehand. The bank also operates the Target 2 payment system. For the brief history, the European Central Bank is the de facto successor of the European Monetary Institute, or EMI. The EMI was established at the start of the second stage of the European Union Economic and Monetary Union, or EMU, to handle the transitional issues of states adopting the euro and prepare for the creation of the ECB and European System of Central Banks, or ESCB. The EMI itself took over from the earlier European Monetary Cooperation Fund, or EMCF. The ECB formally replaced The ECB formally replaced the EMI on June 1, 1998 by virtue of the Treaty on European Union. However, it did not exercise its full powers until the introduction of the euro on January 1, 1999, signaling the third stage of EMU. The bank was the final institution needed for EMU as outlined by the EMU. So, the ECB was established on June 1, 1998. The first president of the bank was Wim Doelsenberg, the former president of the Dutch Central Bank and the European Monetary Institute. Jean-Claude Trichet replaced Doelsenberg in 2003. In the same administration, the European Central Bank underwent through a deep internal transformation as it faced the global financial crisis and the Eurozone debt crisis in year 2008 up to 2014. On November 1, 2011, Mario Draghi replaced Jean-Claude Trichet as president of the ECB. This change in leadership also marks the start of the new era under which the ECB will become more and more interventionist and eventually ended the Eurozone's sovereign debt crisis. In July 2019, European Union leaders nominated Christine Lagarde to replace Mario Draghi as ECB president. Lagarde resigned from her position as managing director of the International Monetary Fund in July 2019 and formally took over the ECB's presidency on November 1, 2019. Lagarde immediately signaled a change of style in ECB's leadership. She embarked the ECB into a strategic review of the ECB's monetary policy strategy, an exercise the ECB had not done for 17 years. As part of this exercise, Lagarde committed the ECB to look into how monetary policy could contribute to address the climate change and promised that no stone would be left unturned. The ECB president also adopted a change of communication style, in particular in her use of social media to promote gender equality and by opening dialogue with civil society stakeholders. Structure of ECB. The ECB has three decision-making bodies: the General Council, which comprises the President of the ECB, the Vice President of the ECB, and the governors of the national central banks of the 27 European Union member states. In other words, General Council includes representatives of 19 euro area countries and the 8 non-euro area countries. Next, the Governing Council is the main decision-making body of the ECB. It consists of the six members of the Executive Board plus the governors of the national central banks of the 19 euro area countries. And lastly, the Executive Board consists of the President, the Vice President, and the four other members. All members are appointed by European Council, acting by a qualified majority. General Council, the mission is to contribute to the ECB's advisory and coordination work and helps prepare for new countries joining the euro. The members are ECB President, Vice President, and governors of the National Central Bank of all 28 European Union countries. While in Governing Council, the mission is to define Eurozone monetary policy and fixes the interest rates. The members are the members of the Executive Board, a total of six, and the governors of the National Central Bank of the Euro area countries. And in Executive Board, the mission is the implementation of monetary policy and the day-to-day running of the bank. The members are the president of the bank, the vice president, and the four other members. They are all appointed for non-renewable terms of 8 years.
Objectives of the European Central Banks. There are three main objectives of European Central Banks. First, maintain price stability. Second, support general economic policies of the European Union states. Third, ensure an open market economy. Acceptable inflation rate is below 2% per year. It is one of the criteria that a country has to meet in order to become a member. The inflation target is the only main goal of the ECB, and this is a major source of criticism. The lesser objective of the ECB include conducting foreign exchange operation, operating payment systems, issuing banknotes, supervising credit institutions. Monetary policy of the European Central Banks. Monetary policy is the control of the quantity of money available in an economy and the channels by which new money is supplied. By managing the money supply, a central banks aim to influence macroeconomics factors including inflation, the rate of consumption, economic growth, and overall liquidity. Monetary policy instrument of the ECB. Open market operations. It is an important tool for managing interest rates, market liquidity, and signaling the next policy movement. Types of operations. The main refinancing operations, the longer-term refinancing operations, fine-tuning operations, structural operations. Second, standard facilities. Standard facilities are to provide and observe overnight liquidity, to signal the general monetary policy stance and bound overnight market interest rates. Two, standing facilities. Marginal lending facility and deposit facility. Third, minimum reserves. Minimum reserves, the governing council of the ECB has decided to apply minimum reserves as an integral part of the operation framework for the monetary policy in stage 3. It provides stability of money markets interest rates.
The Federal Reserve Bank. History. The Federal Reserve is the central banking system of the United States and it's been around for over a century. The Panic of 1907 spurred President Woodrow Wilson to create the Federal Reserve System. He called a National Monetary Commission to evaluate the best response to prevent ongoing financial panics, bank failures, and business bankruptcies. Congress then passed the Federal Reserve Act of 1913. Congress originally designed the Fed to provide the establishment of Federal Reserve banks to furnish an elastic currency to afford means of rediscounting commercial paper to establish a more effective supervision of banking in the United States and for other purposes. Since then, Congress has enacted legislation to expand the Fed's power and purpose. Today, the Fed enacts monetary policy to manage inflation, maximize employment, and establish interest rates. It also oversees the banking system to protect consumers. We'll talk this task in greater depth below. The Federal Reserve is the central bank of the United States. The Fed manages inflation, regulates the national banking system, establishes financial market, protects consumers, and more. Although the Fed board members are appointed the president, it is designed to function independently and political influence. The Fed plays significant role in financial concern that affects the life of all Americans. Creating the Fed. The Federal Reserve Act of 1913, the Federal Reserve System often referred to as the Fed, is a group of 12 regional independent banks. Initially, the Federal Reserve System did not work well because the action of one regional bank could counteract the action of another. A stronger Fed. In 1935, Congress adjusted Federal Reserve structure so that the system could respond more effectively to crises. Today's Fed has more centralized power so that regional banks can work together while still representing their own concerns. Of Fed. The Board of Governors. The Federal Reserve System is overseen by the seven members Board of Governors of the Federal Reserve. Actions taken by Federal Reserve are called monetary policy. Chairman currently Ben Bernanke. The Federal Reserve District. The Federal Reserve System consists of 12 Federal Reserve Districts with the one Federal Reserve Bank per district. The Federal Reserve Bank's monetary are report on economic activity in their district. Member banks. All nationally charactered banks are required to join the Fed. Member banks contribute funds to join the system and receive stock and dividends from the system in returns. This ownership of this system by banks, not government, give the Fed a high degree of political independence. The Federal Open Market Community or FOMC. The FOMC, which consists the Board of Governance and 5 of the 12 district banks presidents, make key decisions about interest rates and the growth of United States of money supply. Structure of the Federal Reserve System.
Objectives of the Federal Reserve Banks. What does the Fed do? Ultimately, the Fed establishes monetary policy. The actions the Federal Reserve takes to influence the level of real GDP and the rate of inflation in the economy. The Fed serves the government, including the federal government's banker. The Fed maintains a checking account for the Treasury Department and processes payments such as Social Security checks and IRS refunds, and government securities auctions. The Fed serves as a financial agent for the Treasury Department and other government agencies. The Fed sells, transfers, and redeems government securities. Also, the Fed handles funds raised from selling Treasury bills, Treasury notes, and Treasury bonds. Also, issuing currency. The district Federal Reserve Banks are responsible for issuing paper currency, while the Department of the Treasury issues coins. The Fed serves banks. Date check clearing. Check clearing is the process of which banks record whose account gives up money and whose account receives money when a customer writes a check. Also, supervising lending practices. To ensure stability in the banking system, the Fed monitors bank reserves throughout the system. The Fed also protects consumers by enforcing truth in lending laws and lender of last resort. In case of economic emergency, commercial banks can borrow funds from the Federal Reserve. The interest rate at which banks can borrow money from the Fed is called the discount rate. The interest rate that banks charge to each other is called the federal funds rate. This is the key interest rate that drives many other interest rates. The Fed regulates bank examinations. The Federal Reserve examines banks periodically to ensure that each institution is obeying laws and regulations. Examiners may also force banks to sell risky investments if their net worth or total assets minus total liabilities falls too low. Also, the Fed regulates reserves. Each financial institution that holds deposit for its customers must report daily to the Fed about its reserves and activities. The Fed uses these reserves to control how much money is in circulation at any one time. The Fed keeps the economy stable, or the Fed tries to keep the economy stable. Stabilizing the economy, the Fed monitors the supply of and the demand for money in an effort to keep inflation rates stable. Monetary policy strategies of the Federal Reserve Banks. Monetarism is the belief that the money supply is the most important factor in macroeconomic performance. The money supply and interest rates. The market for money is like any other, and therefore the price for money, the interest rate, is high when the money supply is low and is low when the money supply is large. Interest rates and spending. If the Fed adopts an easy money policy, it will increase the money supply. This will lower interest rates and increase spending. This causes the economy to expand. If the Fed adopts a tight money policy, it will decrease the money supply. This will push interest rates up and will decrease spending. Good timing and bad timing. Properly timed economic policy will minimize inflation at the peak of the business cycle and limit the effects of recessions in the trough. While in bad timing, if stabilization policy is not timed properly, it can actually make the business cycle worse. Policy lags in timing. Inside lags. An inside lag is a delay in implementing monetary policy. Inside lags are caused by the time it actually takes to identify a shift in the business cycle. Outside lags. Outside lags are the time it takes for monetary policy to take effect once enacted. Predicting the cycle. The Federal Reserve must not only react to current trends but also must anticipate changes in the economy. Monetary policy and inflation. Expansionary policies enacted at the wrong time can push inflation even higher. If the current phase of the business cycle is anticipated to be short, policymakers may choose to let the cycle fix itself. If a recession is expected to last 4 years, most economists will favor a more active monetary policy.